here at Edison, and we are joined by Charles Jillings, who is the CEO of ICM Investment Management and the Portfolio Manager of Utilico Emerging Markets Trust, Fadrique Balmaseda, who is an analyst in emerging markets at WhiteOak Capital, and Amber Gordon, who is Associate Investment Director for Fidelity, looking after emerging markets and thematic equities. Just going to go around the room quickly to each one of us introduce ourselves, starting with Charles. Do you want to say hello, Charles?
Pleasure. Thank you, Andrew, and thank you for having me. I'm Charles Jillings. I'm the fund manager for Utilico Emerging Markets. I've been the fund manager since we launched in 2005, so seen lots of change over the decades. And certainly it's a fascinating space at the moment.
Thank you, Charles. Amber?
Yeah, thank you, Fraser, and thanks very much for having me on the webinar. Great to be here. So yeah, I'm Amber Gordon. I am the Investment Director for Fidelity International's Global Emerging Market Equity franchise. So that encapsulates about $18 billion of client assets under management, and that includes both our core global emerging market strategy, which is managed by Nick Price and Chris Tennant, a number of regional strategies, and then probably most pertinent for this audience, Fidelity Emerging Markets Limited, which is our investment trust in the space.
Thank you. And Fadrique?
Thanks, Fraser, and thanks everyone for joining. So I'm Fadrique. I'm part of the investment team at WhiteOak. We currently manage two global emerging market strategies. One is the Ashoka WhiteOak EM Trust, which we launched just over a year ago. And we also have a UCITS fund, which has a slightly longer track record.
Excellent. Thank you, everybody. So the way we were going to run this afternoon session was to explore four different questions or thoughts, and then each person attending will have a chance to sort of give their views and their thoughts of what's relevant to their particular area and their outlook. So the first one, I'll just run through them and then we'll go to the first one, but just to give everybody an idea of what we're going to be talking about. The first one was to look at the current growth drivers in emerging markets. Secondly, we're then going to be looking at the changing attitudes towards corporate governance and what that means for shareholder returns. Then we would look at current valuation differentials between emerging markets and developed markets and what are the opportunities for re-ratings. And then lastly, we'll ask the question as to why now. So if we start with, Charles, I'll start with you because of you're at the top of my screen. If we're looking at the current growth drivers in emerging markets, what are you seeing, and what are the most important growth drivers at the minute?
So I think the fundamental growth drivers remain urbanisation and the growing middle class, who are driving economies and driving, if you want, transactions, and those transactions clearly fall to the benefit of corporates in the emerging markets. But we see an overlay on the top of that, which is accelerating that process. And the overlay broadly breaks down into four areas. One's loosely we call energy transition. So much like the developed world, the emerging world is seeking to move to a more renewable and a more sustainable energy base, and it is also looking to improve its energy security, so it's not hostage to events outside their borders. So both of those, if you want, drivers within energy transition is seeing significant growth in wind farms, solar, hydro, transmission, etc. We're then seeing an explosion in digital infra. I think the whole world has moved from, if you want, physical transactions to digital transactions, be it banking, be it online services, and just participation in the economy. And within the emerging markets, that's absolutely a key driver. And again, we're seeing growth of things like data centers, but service suppliers to that space, and all the communications linkages. The third area we're seeing is social infrastructure. So much of the emerging markets still needs to catch up in terms of sanitation and urban transportation. So lots of investment going into those aspects. Finally, global trade. And usually people, when they hear me talk about it, say, but that must be a challenge. It's a challenge in as much as there is friction between, if you want loosely, the US and China. And I also think there is an overhang from COVID where, if you want, industrialists are looking to shorten their supply chain, and they're looking to, if you want, near shore and reduce the dependency on China. And all of that activity is certainly driving real opportunities for us. So I think underlying the emerging markets, you have, as I say, the urbanization and the growth of the middle class, but it's being accelerated. You're on mute, Fraser.
Sorry about that. There was a bit of traffic going past me. So thank you, Charles. Fadrique, what are you seeing then as the in your particular areas as the key drivers for your markets?
Yeah, I would, not much to add to what Charles has said. For us, particularly strong, obviously, is the demographic trend in emerging markets. 500 million new people are expected to join the workforce in EMs over the next decade, and that's 2 times the current US workforce. And another data point which we find interesting, over the last 20 years, EMs have contributed 2/3 of global GDP growth. We expect that to continue.
And Amber, then what in your experience are you seeing as drivers?
Yeah, so I think there's probably 3 main areas that we're seeing, particularly at the moment, and that would be commodities, AI and technology, and then also that trend of shifting supply chains and nearshoring that Charles mentioned as well. So with regard to commodities, obviously this is a huge driver for emerging markets. Part of the reason why emerging markets have been so weak over the past decade is due to that commodity bubble bursting in 2014, obviously linked to slowing demand from China property, which has been exacerbated in recent years. But looking ahead, we see a much tighter environment for the commodity space. I think there is dispersion beneath the surface. Obviously, something like iron ore, where 30% of demand comes from China property, we have a much more muted outlook. But really, just going back to what Charles was saying about the energy transition, I've got a much more constructive outlook for something like copper, where we see a significant increase in demand coming online, both due to electrification, also use of AI in data centers as well. And that's coupled with a very muted supply backdrop. Essentially, the world has mined all the copper that is to be had at the moment. We see declining grades in existing mines, very little supply coming online. So that should absolutely be a boost for EM economies and those copper exporting economies in particular. Just touching briefly on that AI and technology point. So I think when people think about AI beneficiaries, they tend to think about US companies, and particularly NVIDIA. And really what this ignores is the fact that a large part of the supply chain for AI is really in Asia, and particularly in Taiwan. So for example, if you have TSMC, the Taiwanese business that accounts for 60% of the global foundry market. So not only are these companies also trading on much more attractive valuations than many of their DM peers, but they also have much more defendable, deeper moats. So we see foundries being less competitive than other parts of the AI value chain. So really strong growth opportunities there. And then just to touch briefly on the theme of nearshoring, I think there's definitely winners from that. Mexico would be a key one. It only takes 36 to 48 hours to shift goods from northern Mexico to Chicago. That's compared to 25 days for China. So Mexico is a key beneficiary there. We have a number of holdings in the portfolio, like GMXT, a logistics company that stands to benefit from that. But probably the final point to make there is that people assume that Chinese businesses are inevitably losers. I think what we've actually seen is a number of Chinese companies be very innovative in terms of shifting manufacturing bases to these friendly partner countries. So, for example, BYD, the auto company, setting up manufacturing bases in Brazil, Hungary, Thailand. So it's quite a complex picture, and sort of no clear winners and losers coming out of that.
If I can add to this. We agree with what's been said, but many people tend to think first of Mexico is a beneficiary of nearshoring. We also see India as a huge beneficiary. So there's this Make in India initiative, which is supported by the Modi government. And that's now coming to 10-year track record. Since then, foreign direct investment in India has doubled. And we've seen meaningful investments from global companies such as Apple, Airbus, Samsung, Boeing, etc. As an anecdotal data point, 40%, 14.14 of iPhone production globally is now produced in India, and Apple wants to double that number over the next few years.
Thank you. Can I just ask you, there's always been the argument of emerging markets and differential growth rates. Are we starting to see that actually emerging markets are, I mean, we've seen figures that come from China, but what makes it different now? Are they actually starting to grow even faster, more consistently than developed markets? Charles? We can't hear you, Charles. You might be on mute now.
If you look at the emerging markets, I think all of them are more resilient than what they were 10 years ago, 15 years ago, 20 years ago. You know, they now have a capital market within their economies, and they understand the challenges that they face because of the nature of their economies. But their economies are improving at a rapid rate. And I think people don't keep up with that performance. So if I looked at Eastern Europe, the amount of capital that the EU is pouring into Eastern Europe to, if you want, bring those economies which joined up to European standards runs at billions. And the investment that's gone in for nearshoring, the nearshoring story in places like Romania and Poland, exactly the same as nearshoring in Mexico, exactly the same as nearshoring in India and Vietnam for that matter. But it's driving those economies to a level where, if you want, the volatility is lower. What I would say for all of them, they still remain highly competitive. If you look at the cost of labor, all of them are markedly competitive. And industrialists, I think, look at those economies and relocate their manufacturing bases to take advantage of skill, which is higher than people anticipate, I think, take advantage of low cost, but also take advantage of, you know, proximity, as Amber was saying. So those drivers are definitely going to underpin further GDP growth. If you look across the growth, though, it's fairly strong. I think if you disaggregate it and say, well, what's the growth in digital? I think Amber would tell you it's incredibly strong.
Yes, yes. So Amber, I guess that's asking the same question. Moving the question to you, what are we seeing as to relatives to growth figures now relative to what they were 10 years ago?
Yeah, so I suppose in just taking a step back and looking more at sort of the fundamental backdrop more broadly for emerging markets, I think that's been a really notable feature of this cycle, in that we generally see much more resilience amongst EM economies than we have done historically. So I mean, Charles mentioned that you know, we see better growth rates than 10 years ago, and I'd say that, yeah, probably the most pertinent period to think about would be something like the 2013 taper tantrum, where obviously you saw emerging markets incredibly vulnerable to any tightening of monetary policy in the US. You saw big outflows out of those economies. And this time around, with the current rate hiking cycle, you absolutely have not seen that. We've seen currencies hold up really well. And that's largely because EM economies are in a much better position than they have been in the past. You see less dollar denominated debt, sort of lower interest expense, better current account balances, higher foreign exchange reserves. And that's just placing many of these emerging markets in an increasingly good position going forward. And that's sort of without factoring in that more buoyant commodity price environment that I mentioned before, which absolutely should be supportive for growth going forward, in addition to all those other growth drivers like AI, technology, etc., that I mentioned.
Yes, yes. And Fadrique, in your area, you're sort of experienced, and the growth is definitely accelerating. Is that Is that fair?
Absolutely. So I'd like to reinforce what Amber and Charles just said. So historically, EMs have been associated to high macro instability. Whenever there was a macro downturn, EMs would be hit hardest. And people think of EMs like high inflation and low growth when things go wrong. If you look now, where there is some kind of financial stress, it's in fact the opposite. So on average, emerging markets have lower inflation, higher growth, and lower public debt to GDP than most developed markets, certainly than Europe, and they're more or less in line with the US.
That's very interesting, and that leads us on. Charles, you mentioned this. Many of the emerging markets have got their own capital markets infrastructure. Part of the requirement for a good capital markets infrastructure is decent corporate governance and decent fair treatment of shareholders. Well, what impact does that have on how many of these companies are going to interact with their investors, and what does that mean for shareholder returns, be that dividends, be that share buybacks, or other practices?
No, I think the emerging markets are quick learners. They understand they need to tap into, the corporates need to tap into, if you want the local market capital, but also the capital that all of us bring around this table. And I would say, a number are now best in class in terms of their relationship with their shareholders and their behavior. So governance has certainly improved. And I think I'd drag it slightly wider than that. If I look at places like Brazil, giving stronger independence to the central bank is a very strong feature. Mm-hmm. And a number of these economies have strengthened their institutions. I think it's the job of investors around the table like us to look beyond the noise of, say, a Lula, who is very often speaking to his sort of, if you want, the election base. But the reality is that very strong institutions which temper what he can achieve.
And then, Amber, what do you see in the stocks that you're looking at as to acceptance of best governance, and what does that mean for shareholders?
Yeah, so I think we've seen some really important steps in the right direction in terms of corporate governance this year, and particularly with regards to the return of capital to shareholders. So that's a really important focus of ours. We're managing Fidelity Emerging Markets Limited. And some of the most encouraging signs we see are actually in China this year. So what we saw back in January was the authorities come out and start to encourage SOEs to return more capital to shareholders. So that was both to convey management confidence in the business, but also to boost shareholder returns as well. And then since then, we've seen a lot of self-initiated efforts amongst the private companies and a number of really big index heavyweights in the China index as well. So I'm thinking companies like Alibaba, Tencent. And actually, this is coming through in sort of quantitative measures through the data as well. So if I quote JP Morgan data, they had a look at the value of share buybacks the year to date to the end of May. They found that MSCI China companies had carried out about $11 billion worth of buybacks over that period. And that's 2.2 times the average over comparable periods 21 to 2023. So quite a notable uptick there. And we're really seeing that come through with some of the portfolio holdings as well. So if I think of the number of the consumer and the internet companies we hold, so Alibaba, NetEase, the gaming company, VIP Shop, they're all returning in the range of 10% of their market cap to shareholders, which obviously when valuations are so depressed is very value accretive. And I always use VIP Shop as a really good example of this. So this is an online flash retailer. I always think of it as a TK Maxx equivalent. It's a company that's obviously been impacted by weak consumption trends in China. But one of the really important ways it's been providing a measure of downside protection for its share price has been by carrying out very generous share buybacks. So it's got an $8.5 billion market cap. And in 2023, it had a $700 million buyback, a $250 million dividend. So you can see sort of very attractive return of capital to shareholders. And I think this is something that we have been engaging with companies on for a number of years. So it's really encouraging to see that development in China this year.
And does that follow through that is a big part of the emerging market opportunity through dividends, or are investors to expect that in capital gains?
Yeah, so through dividends and buybacks, and so that's something we have increasingly seen in China, and I think whereas people used to invest in China for growth, there is an acknowledgement that given sort of cyclical weakness in the property sector, but also due to worsening demographics as well, China obviously now has an aging population. You can no longer invest in China solely for growth as you did historically, and so therefore you need to seek out other means of total shareholder return, and aspects like buybacks and dividends are really an increasingly important part of that.
Thank you. And Fadrique, then what are you seeing from the adoptions of best practice in corporate governance and shareholder returns?
Absolutely. So similar trends we are seeing, sometimes led by the government, others led by the corporates themselves, but clear trend towards improving governance. Reality, we need to acknowledge we're still not where the US or European developed markets are in terms of governance on average, but I think we're moving in the right direction, and that's what matters. And also, we don't need to see every company within the best governance practices, as long as there are some companies, and in some of these countries, you can find thousands of companies, such as India and China, even though on average it's not where the US or developed markets are. You do have many companies with top-notch governance. I think if we can pick those, it allows us to extract good returns.
I suppose another question that leads on from that is, do these companies, or the companies that you're looking at, and I appreciate we're talking about a vast swathe of opportunities, but the ones that you probably get to meet, are they actively looking for international capital? Do they want to be seen, the international standard? Or is there, historically there's been an attitude of, I'll take that money when I need it, but when things get tough, I'm not that interested in the international shareholder. Amber, what do you see there?
Yeah, I mean, I think you are seeing shifts. For example, if I take the China market, for example, you have seen a massive outflow of international capital from that market. If you have a look at something like US public pension fund investment in China, it's fallen from something like $5 billion in 2020 to $500 million in 2023. So you've really seen that decline. A large part of the reason why we saw such significant weakness in the Hong Kong market over the course of 2023 was really due to foreign international investors exiting the market, and that's caused significant weakness there. So I think there is an acknowledgement that not only domestic investors are important, but also international investors, in order to regain some kind of stability in the market. So I think without sitting on the fence, a bit of both.
Charles, what do you see in that space, as far as, I guess this is as much about attitudes and a willingness to keep engaging with the international investor community?
By and large, I think the investments, or the companies we're investing in, have big capital projects. So 95% plus are operational. So they'll own an airport, or they'll own a port, and they'll be operating it. And just as a byline, over 80% pay a dividend. What I would say is that a large capital project, a new airport terminal, extending a berth, adding a whole new 100-kilometer motorway, is significant. And so they have capital events which come along. And the depth of the market is such that if they can attract in the international capital, I think they look at it favorably. And they certainly are embracing of external capital.
And does that have a knock-on effect in the more international capital they can attract, that's seen as a sort of endorsement locally? Quite often you see that, and it can outdrive the sort of valuations up as well.
I think that's the case, although the local markets are fairly deep and dynamic in themselves. And we'll come on to valuations, no doubt, later. But it does help, certainly in our space, for them to have us on their registers. I think we're seen as somebody who's highly specialist, investing in infrastructure and utilities. So the nature of the relationship is deeper.
So Fadrique, and what do you see then as to how easy it is to engage with the companies you invest in and their willingness to accept international capital?
I wouldn't say we've seen a change there. We've always seen companies very willing to meet us, either locally there when we go travel, or they also come to London and to Europe roadshows, and they're keen to meet us. So yeah, certainly very keen to not only to meet, also to engage regarding improved disclosures, etc. when we want to engage with them in that sense.
That's brilliant. That's really
And
good to hear. Yeah, go on,
just to reiterate what Fadrique was saying, I mean, obviously, going out and visiting these companies on their home turf is incredibly important, and particularly when we've got these stories of corporate change. Taking a step back from Asia, which I was talking about before, having a think about something like Poland. So you've seen quite a notable governance change there over the last year. So you had the election last autumn where the PIS party was replaced by Donald Tusk's party. So seeing positive developments there, the release of EU funding. But I think most importantly, we were also getting a sense that the management teams of a number of SOEs were being replaced with much higher quality management teams that had essentially been appointed for reasons of meritocracy. But in order to properly assess that, we needed to go and visit these companies and scope it out for ourselves. And so our investment team visited Poland in April, and were able to meet with some of the new management teams, for example, of PKO Bank, and sort of had a sort of very favourable experience, and it really reinforced the view that we are seeing a genuine story of corporate change in that market. So yeah, just to reiterate that point, travel is obviously incredibly important.
Thank you. So just moving on to the third question, and just for everybody who's listening, please do, if you want to think of a question at a particular at any point in the webinar, there's the opportunity to ask those questions on the chat, and then we can pick them up either now or at the end of the formal part of the webinar. So I guess this is number 3. We're looking at current valuation differentials. What opportunities are we seeing? What opportunities are there for re-ratings between developed markets and emerging markets? Have investors missed the boat, or is there a lot more to go for? Charles, back to you.
So I think I'm sure we're all going to agree emerging markets at the moment is cheap, and certainly compared to, if you want, the US, to me looks really highly valued. So the emerging markets, I think, are cheap on any metric, and are therefore attractive. What I would note, I think, is much like the developed world, investors are investing into equities, investing into fixed income because of the high interest rate. And so you're not seeing, if you want, the marginal investor investing in equities. And I would say, if I look at everywhere from Brazil through to Vietnam, through to Philippines, the local market is not participating as strongly as you might expect, and therefore it's still subdued. And I think the valuations in our portfolio are certainly below trend. If you look at any metric, they are below the long-term trend, and that's attractive for high growth assets. I always think people don't quite understand the growth metrics that can be achieved for some of these companies in emerging markets.
I think we may have lost Fraser. I'm happy to jump in his absence. Yes. No, I just.
Hear me?
Yes, we can.
Sorry,
We can.
I've just got a camera issue, but so I just carry on. Amber, yeah, thank you. Well, why don't you carry on as to what are you seeing as the current valuation differentials, and how's that going to lead to re-ratings for stocks?
Yeah, absolutely. So, I mean, just to really reiterate what Charles was saying, I think there's an incredible value opportunity at the moment. I mean, if you have a look at the EM index on a price to book basis, it's trading at a 48% discount to developed markets. That's relative to a long-term average of 24%. It's the lowest level in 25 years. So incredibly cheap. I think we're well aware of the reasons for that. It's due to weakness in China, commodity prices, which I was talking about before, geopolitical turbulence. But that doesn't mean that there aren't a lot of very high quality, fundamentally attractive companies out there at very cheap prices. And probably the point to make is that, again, there's huge dispersion beneath the surface. You do have markets within EM that are very expensive, both relative to history and DM. So if you have something like India, currently more expensive on a PE basis than the US, Taiwan, obviously relatively expensive as well. But then on the other side of the spectrum, where do we see opportunities for a potential re-rating? I would probably point to Brazil and China. So starting off with Brazil trading on 7 times earnings, a 15-year low. So the weakness this year has largely been due to concerns about the pace of rate cuts. So Brazil started cutting interest rates last year, but had to remain on hold this year as the Fed has remained on hold. But in an environment where real rates are so high, we are broadly of the view that rates will be able to start coming down once the Fed starts to ease, and that should be an enormous boost for the consumer, for corporates, help drive flows to equity markets as well. So we really think that market is ripe for a potential re-rating. To touch on the other super cheap market in the universe, and that is China. So incredibly cheap. China's total return index has halved since 2021. That's largely been due to persistent weakness in the property market. We've obviously seen the government look to deleverage property developers, look to right size the industry, take out excess capacity. That has resulted in prolonged weakness in the whole market, not least because China property accounts for about 60% of household wealth. So weakness there has a really big knock-on impact on consumer confidence. I think we've started to see cautious sort of green shoots this year as the government has sought to shift away from deleveraging and more towards reflating the property market. So we are of the view that if the government does manage to put a floor under property price declines, that could be incrementally positive for the market. And so, yeah, given where current valuations are, if I take an example from the portfolio, you have something like a China Mengyu Dairy, one of the leading dairy producers in China, that has derated from something like 30 times earnings to 10 times earnings over the course of 18 months. So valuations really are at record low levels in that market.
And Fadrique, what do you see?
Absolutely. So we agree. Amber mentioned price to book, and I think there are other metrics which are at multi-decade lows if you compare EM versus DM valuations. So we try not to make macro calls, so we struggle to say now is the best time to invest in emerging markets, but it certainly looks like it's not the worst of times and could end up being a great time to invest in emerging markets. It's also interesting for us. We think everyone's looking back at most a decade, but if you look at longer cycles, you'll see things a bit different. So since 2010, when, as Amber said at the beginning, commodities peaked, or the commodity cycle, EM equities have meaningfully underperformed developed market equities. But if you were to have a look at the previous decade, so from 2000 to 2010, EM equities meaningfully outperformed the developed market equities. And if you look at the 2 decades combined, in fact, returns across emerging markets and developed markets have been broadly similar, and both have given broadly similar returns to what you should expect on long-term returns, which is earnings growth. Okay, and as we said today, as we stand, there's no reason for us to believe that EM will grow slower than developed markets. I think we should expect the same kind of returns. It's also interesting, if you were to have sat here in 2010, you couldn't have more emerging markets, right? Everyone was super bullish emerging markets because we'd just come out of a decade of very strong returns for emerging markets. Now it's the opposite. We think positioning in emerging markets is very light, and it's not surprising because we've just come out of more than a decade of underperformance of emerging markets.
So Fadrique, just stick with you then. What do you think is there anything that needs to be, is there a trigger? What's going to be the marker? So in the UK, for example, I think it's clear that everyone has been waiting for the election to go through. And I appreciate emerging markets. We're talking about a lot of different countries.
Absolutely, yeah.
But from an investment perspective, what is there something that we should be looking for that is a trigger that will shift the valuation differentials?
I think, from an index level, the broader emerging markets, obviously, weaker dollar is a beneficiary. Capital tends to flow towards emerging markets. Commodities are widely perceived as a strong driver for emerging markets, but that is somewhat less the case than it used to be historically. A case, for example, energy now only represents 5% of the benchmark. So technology and consumer have become much larger as they are in developed markets than they used to be. And commodities in that sense obviously helps emerging markets, but it's not as strong as a driver as it used to be. But what we think is important when you're thinking of returns in emerging markets, it is the fact that emerging markets are a much more inefficient segment versus developed markets. Okay, so the alpha opportunity is just much larger than in developed markets. So people tend to think of the benchmark or index level return, but often you invest through an active fund, okay? And some active EM funds have proven that you can generate 5, 6, sometimes more percentage points of alpha per annum fairly consistently. Those kind of returns or that kind of alpha is unthinkable of in developed markets. Okay? In other words, if you pick a top decile EM fund, you will see several points more of alpha than in a top decile developed market fund. So even if we assume that at the index or benchmark level, you get the same returns in developed markets and emerging markets, if you pick the right fund within emerging markets, that should drive meaningful outperformance, we think.
Thank you. So Charles, what are you seeing then as the key reasons? We're seeing that the markets are faster growth, building momentum, accepting best practice, valuation discounts. I mean, I suppose I'll answer the question for you as to why now? Why should we be investing in emerging markets now?
All of the above. I think the world has had to deal with an American economy which is extremely strong and therefore a high interest rate, which flows through into the rest of the world. Capital has been sucked back up into the US dollar. So what's going to change? I think inflation in the US is now under control, and therefore more likely the cutting cycle is going to start. And I think the emerging market central banks will find it easier to ease their high burden of interest costs. So that's one factor that I think is coming. I mean, we can all have a debate. I think if we were all here in January, we would have started by now. But the signs are increasingly firming for that process to start, and it will result in a weaker dollar. And as Fadrique says, capital will flow out usually into the emerging markets. The one hesitancy I think all of us are need to just pay attention to is the US elections and quite how that falls, and is there just an escalation in friction? Personally, I don't think it's something to be concerned about over the medium term. I think if you want, a lot of it is somewhat bluster. And if I made an observation, the NAFTA agreement in North America, so Canada, the US and Mexico, was actually renegotiated by Trump, and it was one of the good agreements that he put in place. I can't see why he's going to try and unpack it. He might knock it at the edges, but it was a fabulous agreement, and Mexico's been a big beneficiary from that. But I do think the markets will just be slightly hesitant until they know with certainty how, if you want, that outcome of that election lands and the policies that flow from it. But I go back to it. If you want, I think the emerging markets are on a sustainable upward path. And if you look at the levels, as Fadrique says, the levels of GDP growth achieved, the levels of export growth achieved, these markets will perform.
It's very encouraging. Amber, what was the Fidelity view at the minute?
Yeah, so really just to echo some of the points that have been made, I think vital to the outlook of EMs for the rest of the year is really the backdrop for rates and inflation. So as Charles indicated, we'd be having a very different conversation if we were speaking in January. Back then, the market was pricing in 6 Fed rate cuts. If you took Brazil, for example, it started cutting rates from 14% down to 10%, starting the previous August. I think it was a pretty rosy outlook for EMs and their cutting trajectories more broadly. We've obviously seen quite a significant repricing of central bank policy over the past 6 months, as the Fed has remained on hold. However, just to reiterate what Charles was saying, real rates are incredibly high in places like Brazil, also Mexico. And so once the Fed does move, and it could potentially move as early as September, we don't tend to take macro calls on these things, but once the Fed does move, it will give the green light for EMs to continue on their easing trajectory, and this will be enormously supportive for the asset class, and will also help ease pressure on the dollar as well. So typically a headwind for EM equities. I think China is incredibly important. So China's weight in the broader EM index has fallen from its peak. It's peaked at about 40% in 2021. Obviously, it's performed very weakly since then, and so its weighting has fallen down to just under 30%. But that is still a significant proportion of the universe. So what goes on in China has meaningful implications for the rest of the EM space. And I think the thing we are monitoring really closely now is just whether or not the government will be able to put a floor in those property price declines. And that's going to be really, really vital to pushing consumer confidence in the right direction and allowing the consumer to feel like they can go out and spend again. So a potential risk on the horizon would be a hard landing for the China property market. But we are of the view that sort of all the measures the government has taken in recent months, so things like encouraging banks to go out and lend to developers, the inventory repurchase program, cuts to key mortgage rates, all of these things, while they're not designed to really inject any kind of meaningful stimulus in the market, that's not what they want to do. I think it will help to put a floor in prices, and that will be incrementally positive for EMs as well. And then just touching on the final point, and that's the US election, that is incredibly important. I think jitteriness, to quote Charles, will persist in the months to November. I think that probably means that we will see more weakness in the EM space over the next couple of months than we have done in the first half of the year. I'm also of the view that I think regardless of the outcome, it might not necessarily be as bad as investors anticipate. If you take the trade deals, sort of all eyes are going to be on the USMCA trade deal that replaced NAFTA, which is due to be renegotiated in 2026. People will be watching that very closely. And yeah, that's something we continue to pay very close attention to, and it's sort of we are positioning for. So, for example, that is largely why our China exposure is predominantly to the more domestic names, so those consumer and internet names, rather than to those export dependent names that could potentially be made uncompetitive through increased tariffs. But yeah, the US election will clearly be something to watch closely. But I think broadly, just to reiterate what we've been saying, I think that the backdrop is positive. Valuations are incredibly cheap. We're seeing improving corporate governance practices, capital returns to shareholders, a more buoyant commodity price environment. And so, yeah, I think we're pretty positive on the outlook.
That's very exciting. Again, just more generally asking the question as to, is international capital plays a very significant role in shifting the valuations? I.e., if we're talking about valuations, but I guess if you're in the local market, you're a local investor, you're living that anyway. Whereas actually, if it is, well, what is the shift that's going to bring North American capital more into emerging markets? I'd say North America is just more of it than they're probably coming from the UK. But is it the international capital moving into the markets, i.e., they've got to see that there's an opportunity to take money, or they want to take money out of North America and put it in other areas, or do all the local investors, look at their market and suddenly go, gosh, it's cheap, we ought to buy more shares. But Fadrique, what do you see? Because your area of expertise has got a very healthy local investor uptake, hasn't it?
Yeah, but honestly, no strong views on that. I'm not sure. Obviously, international capital are big pools of capital, and I'm assuming over time it can impact valuation, but no hard data there, to be honest.
Charles, I mean, your area of investment, I guess, is very reliant on international capital, isn't it? And we see a lot of, there's a lot of talk about Chinese money that is playing a big part in global infrastructure.
I think in global infrastructure clearly offers, the benefit of stability in terms of cash flows, in terms of the concessions and the nature of the asset. So they do attract in international capital. But I think the pleasing thing is the local markets are highly competitive, and you're seeing participants from the local markets compete. I think trying to answer your question about what will make it turn, I think if it'll come down to people's view on return. And I go back to Amber. Real interest rates have never been higher in Brazil. And if you are a Brazilian person looking to invest at the moment, you can nearly make 1% a month out of fixed income. Why are you trying to chase the equity return? And I think, if you want international capital, large part of which comes out of the US markets, is enjoying a high rate of return on fixed income. And so they are, at the moment, quite happy to sit where they are. I think if interest rates, as I say, come down in the US, the US investor will then start to look for alternative returns. And as Fadrique says, emerging markets offer that opportunity.
Thank you. Then, Amber, then what do you see? You're part of a global institution, so you have a sort of, I guess, much more of a global view than some others. What are you seeing within that regard of the flow of international capital and what influence that has on valuations?
Yeah, I think it really goes down to what the Fed does at the end of the day. I think once the Fed does start cutting, you will get investors looking to reallocate capital to areas where there is essentially higher rates, higher yields, markets like Brazil, like Mexico. I suppose the caveat to all of that is investors have to feel sufficiently comfortable and not risk averse to feel comfortable allocating to those markets. So you also have to have the element of political stability as well. Mexico would probably be a good example of this. So Mexico, the peso was kind of the darling EM FX trade of the last couple of months. The Mexican market sort of do incredibly well, the stock market over the course of 23, and then you saw that unwind pretty spectacularly in the aftermath of the election about a month or so ago. So it just goes to show that no matter how positive the sort of carry environment is, if you get a political shock, that can then impact flows as well. Just going to that point specifically on Mexico, I think we're of the view that the market moves were sort of fairly overblown. So just to reiterate what happened, Claudia Sheinbaum achieved a sort of supermajority in the Congress, and some concerns have been raised about lack of checks and balances on her governing party. But broadly, we do see her to be fairly sort of pro industry, seen some very positive noises in terms of central bank independence, amiable relations with the US, aspects like that. But really, the point I'm trying to make is that you do need that sort of geopolitical stability, domestic political stability to encourage those flows.
Yeah. Look, I'm going to answer some questions that have come in the last 10 minutes. And just leading on from that, there was a question: is the government structure a key differential to take into consideration when looking at emerging markets? Fadrique, do you want to start with that one?
I think for sure, within emerging markets, as we've said multiple times, very heterogeneous segment of the market. And obviously, we strongly believe that well-governed countries at the government level, and that obviously largely a function of government structure, has a large impact on governance at the corporate level, and therefore the returns or our ability to extract alpha from those markets.
Yeah.
An easy example, obviously, we think India is a very well-run democracy, as we've seen recently in the recent elections, with rule of law and separation of powers, respect of property rights. Many of those things don't apply, certainly to the same extent, in China, and we think that largely explains the valuation and disparity between those two markets. But yeah, indeed has a huge impact on market multiples for each country within emerging markets.
Yes. And Charles, when you're looking at where you're investing, how much of an influence is the government structure? And does that ever put you off that you think I wouldn't look at that country?
So I think I look at the stability, the corporate that we're investing in. If it's operating in a country which has good structures around it, be it the senates or the chambers or the government, and good regulation, good legal system, I think I'm a little bit more ambivalent as to what the nature of the governing party is. So very comfortable being, if you want an investor in Vietnam, very comfortable being an investor in Brazil, two different government structures. I think the thing for me is to try and understand what the government is seeking to achieve. And as an observation, pretty much all the governments across the EM are looking at significant infrastructure investments, and there are big programs underway in Brazil all the way through to, we haven't named, but the Philippines has a significant program. And I think we try and look at those and understand what's the driver, how do we participate, how do the corporates we're investing in participate, and then what are the returns. But it is important to focus in on a sort of top-down view to make sure that we just don't get assets trapped in an environment from which we really can't recover. I think the other thing that we do try to do at UEM is have a spread of countries, spread of investments, spread of sectors. So you'll see, my top holding ICT, which is a container port operator out of the Philippines, an extraordinary performer, but I hold them at 5% because I think there's enough performance across EM not to, if you want, chase the risk too far.
And Amber, just to stick on the government one, just to give you a chance to, you've got a lot of experience and knowledge of China, which clearly isn't the democracy. How does that sit? I mean, it's such a big part of the emerging markets index, yet it has a completely different political infrastructure. How significant is all of that when Fidelity are looking at where to invest?
Yeah, so it is significant and it is important. I would sort of caveat all of these comments with saying that we are bottom-up investors. So country level positioning in the portfolio will be determined by where we see the most attractive bottom-up opportunities. But this is emerging markets, and you have to invest with a consideration of the top down. It's simply not possible to invest without that. And with regards to China, the risk of government intervention is obviously a very important consideration. So if we think about some of the regulatory headwinds towards the internet sector that we've seen previously, so cancellation of the Ant Financial IPO in 2021, some of the headwinds to the internet sector following that, we've since seen those start to ease, much less of a headwind than they have been historically. But that's definitely a consideration when it comes to investing. And it's not just with regards to China, it's across the whole EM space. If I take something like Brazil, so I was talking about the reasons why the market has been quite weak this year. And one of the reasons I didn't mention was there's been some concerns about the fiscal backdrop in the country. And so what Lula's doing with regards to that. And that's also resulted in some weakness. And although we see lots of exciting bottom-up opportunities there, sort of trying to work out the fiscal trajectory of the government is incredibly important as well. And just to, again, reiterate what Charles was saying, I think a spread of countries and diversifying your country level bets is important, and it's become a really increasing focus of ours over the last 2 years, just given that we are operating in an environment of heightened geopolitical tensions. Having a greater spread of different country level exposures is a really important way of managing the associated risks.
Yes, thank you. So another question. Sorry, I'm going to speed up a little bit because questions are coming in, and I'm we're running tight on time. Liquidity. How significant? What challenges are there in buying good companies because of liquidity in the underlying stock? Fadrique, for you.
I think again very different depending on what country you're looking at. Some countries have very decent liquidity, and more important, massively improving liquidity. For example, in India, the change we've seen in liquidity, obviously markets going up, has helped over the last few years, has been huge. Other markets, I must say, are very disappointing. So some Latin American markets, I'd say if you exclude Brazil, all Latin American markets over the last decade, if you look at the liquidity of this market and the stocks, has been very disappointing. It's basically gone backwards. So it's something you do need to acknowledge when investing in emerging markets, but it's very different depending on what market you're looking at. Yeah.
And Amber, a quick answer for you, liquidity.
Yeah, I mean, I think I sort of agree with everything Fadrique said. I think the only point I would make is that we see that as being one of the key benefits of the Fidelity Emerging Markets Limited Investment Trust. So given its closed-end nature, it essentially enables us to go further down the market cap spectrum and exploit some of those less liquid opportunities that are not appropriate for our open-ended core global emerging markets strategy. And we see lots of really exciting high growth, sort of underappreciated stocks in that part of the market. So that's definitely something we're trying to exploit.
But I guess that as much as liquidity is a function of how long it takes you to get in, it's a question of how quickly, if there's a political crisis in one of your countries, how quickly you can sell, but you're not concerned about that then.
Oh no, yeah, I mean, obviously that's an incredibly important consideration as well, and we're always looking at metrics like that, like days to trade, aspects like that. That's a very key consideration.
And Charles, with your investments, what does that? How significant is liquidity when you're looking at?
So I look at illiquidity as my friend. If I find something and it's cheap, but it takes me 2 months to buy, I'm relaxed. I think you've got to find fundamental value, be prepared to back your convictions. As a bottom-up investor, we're looking for that good return, and as long as we are comfortable about the environment in which the corporate is operating, we can wait. I'm always amazed at actually how much liquidity there is, because when you pitch up with a buy order, very often the market will open up in front of you because of the liquidity. Some of the institutions haven't been able to sell, but no, I look at it as a friend.
Yes, exactly. It's an opportunity for you. Well, I'll just go for one last question as a wrap up, but just to remind everybody, this is part of our series of looking at emerging markets here at Edison. There is the research note that my colleague Milos and his team, Mel Jenner, have published that you can find as a handout and as on our website, edisongroup.com. If you'd like to get further access, follow up with any of the companies, then you can come through us, or you can clearly find out more about them on the website, on the internet. So look, I think just to wrap up for me, look, it's a very, very, as all of you said, it's really exciting. The valuations are looking attractive. The adoptions of best practice are there. And Fadrique, I think you highlighted is that, okay, sometimes someone has to be brave. It's very easy to go with the trend, and just because past performance, as we're always told, is no indicator of future performance. But I'll just go around each of you and give you a chance to answer. But so we're feeling, I guess, from a confidence factor. I'll put you on the spot here. I'll go around, and out of 10, I'm not going to ask you about stock picking, but what is your sort of general confidence levels about the outlook for emerging markets? Amber, I'm going to start with you on that. So give us a quick 1 out of 10 as to what's your confidence factor in the opportunities in emerging markets?
Oh gosh, that's a very, very mean to start with me, and a very, very difficult question to answer. I might try and hedge my bets and say, oh gosh, I'm not sure I could put a number on that. I would say we are cautiously optimistic. I think there's a number of incredibly important drivers, but you can't ignore the risks like the upcoming US election, China property market. So we're very cognizant of those as well.
Yeah. Well, you could argue the US elections as much of an impact for the US market as it is for everyone. Fadrique, give me a score out of 10 as to what your levels of excitement. Okay, I'm not saying it's not about stock performance or anything else. This is just of opportunities for your markets.
So honestly, we're agnostic, as we've said, with regards to macros. So I'd go with a 5 in the sense we've no reason to believe EM will meaningfully outperform developed markets. We've also no reason to believe EM will underperform developed markets, okay, at the equity level. Now, I'll give you a 10 out of 10 in our confidence and our ability to extract alpha from emerging markets and in much larger quantities than in developed markets, which will impact returns, okay, absolute returns.
That's a very thoughtful, analytical answer. Well, thank you. And Charles, then, just to wrap up, then, what are you looking at as prospects for emerging markets? And I'm not talking about stocks here. I'm just what you see. Are these countries are they going to be bigger? This economy is going to be bigger or smaller in the next 10 years? So your optimism level out of 10.
I think if you look over 10 years, I'm optimistic, and I'm optimistic because of demographics. I'm optimistic because of past investment that's gone in that continues to unlock those economies. And I'm optimistic that if you want, the interrelationships geopolitically will resolve themselves and trade will continue to grow and interaction will continue to grow. I think, just as and I know you sort of said don't look backwards, but in the year to 31st March, UEM delivered 12.8% return, which is a good return in tough markets. And I sit here and look at the underlying investments and say, much as we've been saying through this call, they're undervalued still in the local markets, and yet the growth implicit in them remains there. So I'm optimistic. I'm with Amber, though. You have to be cautious. I think you have to come in the morning and say what's happened.
Listen, that's fair. I think anybody who would invest with you would expect that as a level of sensible due diligence. So we're up to the hour. I'm sorry that I could definitely be going. We could run another one of these because we've got lots of other questions and thoughts, and you've been fantastic guest to have on the webinar. So thank you. So I'm just going to go around. Fadrique from WhiteOak Capital, Amber from Fidelity, and Charles from ICM and the Utilica Emerging Markets Trust. Thank you very much for your thoughts, for participating, and leave everybody and wish you all the best of luck for the outcome. I'm going to give you all a 10 out of 10 for your courses today. Thank you.
Thank you.
Bye-bye.
Thank you,
Fraser.
The best.